Institutional investors in India increasingly look for high-growth industrial benchmarks that can scale beyond traditional commodity cycles. From FY21 to FY26, Gravita delivered a 25% revenue CAGR, 31% PAT CAGR, and 49% EBITDA CAGR. Despite market volatility, revenue hit 4,265 crores, stabilizing at a 10.6% adjusted EBITDA margin. This revenue is supported by a physical footprint of 14 manufacturing facilities, providing a processing capacity of 4.57 lakh metric tons annually. The company is now pivoting away from its legacy focus on lead recycling to build a diversified platform capable of processing multiple metal streams simultaneously. This strategy targets a processing capacity of over 8 lakh metric tons by fiscal year 2029, a scale that requires a shift in the company's underlying capital structure. The core of this transition is a 1,700 crore capital expenditure plan. 815 crores are earmarked for expanding established lead and aluminum businesses. The remaining capital supports entry into new recycling verticals, like lithium-ion, rubber, and copper. Management intends to fund this entire expansion through internal accruals, avoiding external equity dilution. The deployment schedule is aggressive, with the highest concentration of spending over the next 3 years. This capital deployment prioritizes value-added products, focusing on high-margin outputs rather than simple processing volume. The existing lead recycling operation provides the predictable cash flow necessary to fund higher-risk expansions in other metals. The Mundra facility is central to this baseline. Its location directly at the port reduces logistical costs for raw material imports and provides immediate access to global export markets. A recent addition of 80,300 metric tons at Mundra has increased Gravita's total lead capacity to over 145,000 tons. Domestic lead sourcing is currently being reshaped by Extended Producer Responsibility Mandates, or EPR, which require battery manufacturers to ensure their products are recycled. To manage these mandates, the government established centralized EPR exchanges. This system is shifting the domestic scrap market from informal, unorganized collectors to compliant, formal recyclers. Trading through an official exchange removes the ability for participants to use under-the-table discounting, effectively creating a transparent pricing floor for raw materials. To ensure the system's integrity, the Central Pollution Control Board performs audits to prevent the issuance of fraudulent recycling credits. This regulatory shift stabilizes Gravita's domestic supply chain, turning the core lead business into a de-risked engine for capital. Gravita leveraged that capital for a 560 crore acquisition of Rashtriya Metal Industries Limited, or RMIL. RMIL operates a facility with 31,200 tons of capacity, which currently runs at a 50% utilization rate. RMIL currently generates roughly 45,000 rupees of EBITDA per ton by processing copper scrap purchased from third-party aggregators. Sourcing from these aggregators limits RMIL's margins, as the profit from the initial recycling step stays with the external supplier. Gravita's backward integration replaces aggregators. A 160 crore investment builds a 29,000-ton upstream facility in Manvi. Manvi will send recycled copper directly into RMIL, bypassing the open market. This pushes RMIL's expected EBITDA to 65,000 rupees per ton. Sourcing for this plant requires a different logistical approach. Most high-grade copper scrap must be imported from developed markets like the US and Australia. To sustain this volume, Gravita will need to expand its international procurement network and physical yard presence over the next 2 years. The RMIL acquisition serves as the anchor point for a vertically integrated copper system. Managing a global copper supply chain requires significant upfront capital to purchase and move material across the ocean. Because of the transit times involved in international shipping, the company's working capital cycle is expected to remain between 85 and 90 days. Gravita enters this phase with a net debt of 118 crores. Funding the copper pipeline requires a significant increase in working capital debt, which is expected to peak between 800 and 900 crores. To mitigate the risk of carrying this much debt, Gravita uses London Metal Exchange hedging to protect against price fluctuations. When copper scrap is purchased, the company simultaneously locks in a future selling price through forward contracts, neutralizing market volatility. Because the price is fixed, management treats the inventory as highly liquid collateral, meaning the debt is backed by the physical value of the metal. This debt is a calculated mathematical requirement to reach the scale necessary for multi-metal market participation. Short-term quarterly data can sometimes diverge from the long-term trend. In Q4, absolute EBITDA fell even as revenue continued to grow. This Q4 drop was primarily due to the ongoing geopolitical instability in the Middle East, which severely disrupted global shipping routes. As shown in this waterfall chart, the conflict increased inward logistics costs while slowing the export of value-added products to key international markets. Margins were also impacted by a decline in aluminum volumes throughout the year. Management intentionally reduced its total aluminum sales because the domestic MCX exchange did not yet have a viable hedging contract to protect the value of the inventory. These quarterly results highlight how external logistics and exchange-based delays can create temporary friction in a recycling model. Evaluating Gravita requires looking past these quarterly variations to the 5-year structural architecture of the company. The model relies on lead operations to generate capital for expansion, while backward integration increases the specific margin earned per ton of metal processed. By 2029, the company expects value-added products to account for 50% of total corporate revenue. Despite temporary market shocks, management has maintained its commitment to the 1,700 crore capital expenditure plan. This spending is designed to move the company toward a total multi-metal capacity of 8 lakh metric tons per annum. By leveraging regulatory formalization and strict financial hedging, Gravita is transitioning into a multi-metal model with high entry barriers and integrated domestic supply chains.